Have you ever asked yourself, how could I build a portfolio that pays me $100,000 per year in dividends? Today I have your answer. Hey guys, my name is Brendan, aka Budget Dog. On my channel we discuss personal finance, financial freedom, and entrepreneurship. If you want to see more of my content and help out my channel, make sure you go subscribe to my channel below by hitting the subscribe button. It means a lot to me and helps out my family. Also, check out my link below to get Investing 101 ebook to get you started today. Many people want $100,000 in dividend income, but that technically isn't the only way to earn $100,000 per year from passive income. You can technically withdraw, let's say 4% from your overall portfolio balance. Using quick math, if you build a portfolio of up to $2.5 million, theoretically you could draw down 4% or $100,000 each year using the Trinity study. Make sure to research that study in the show notes below because I'm not going to go into the detail of that today. Also, note that the 4% rule is not that straightforward always, as there are also tables with withdrawal rates, portfolio construction, and probabilities. But the real reason I'm talking to you today is dividends specifically, and how to earn $100,000 per year in dividend income. But more importantly, what to consider in this process, and most people will cut corners and make the mistakes that I'm forewarning you about today. Dividend investing is very popular. People see huge yields, therefore it's attractive to many. Real dividend investing is not just yield, but it comes down to finding quality companies that pay a consistently increasing dividend. And many novice investors will chase yield, which is a portfolio killer. This is very dangerous, and here is why. A company with a high dividend yield may be good, but it also may be a warning sign. The formula for dividend yield is simple: annual dividends per share divided by current share price. For example, AT&T has a 5.71% dividend yield when recording this video. If their current share price was $19.42, I could do simple algebra to figure out their annual dividends per share, or about $110. Here are 4 items to assess when hunting for quality dividend stocks. Number 1, extremely high yield. Number 2, excessive debt. Number 3, dividends are greater than earnings. Number 4, fundamental business concerns. Number 1, extremely high yield. This is the first giveaway that you might be looking at a dividend yield trap. At the same time, many stocks do pay high yield and they're still legitimate and sustainable, such as QYLD. Again, not a reason to invest though. While a 2 to 5% yield may be reasonable, a 12% yield should make you naturally skeptical. Here are a list of some quality companies with their dividend yields. Home Depot at 2.46%, Altria at 6.93%, P&G at 2.23%, AbbVie at 3.84%, and Chevron at 4.20%. For more quality dividend paying stocks, check out the Dividend Aristocrats list or Dividend Kings list. Number 2, excessive debt. As we know, dividends come from the profits of a company, and they are at the discretion of company management. If a company has a lot of debt on their balance sheet and the economy becomes rocky, this may impact their ability to continue issuing a dividend. The way I assess this is to look at its debt to equity ratio and current ratio. The formula for debt to equity ratio is total liabilities divided by shareholders' equity. Generally, a good debt to equity ratio is anything lower than a 1. A ratio of 2 or higher is usually considered risky. The formula for current ratio is current assets divided by current liabilities. Generally, a good current ratio is anything greater than 1.5 or better. Anything below 1 means that the company may not be able to meet its short-term obligations, and that's an issue. On the flip side, too high of a ratio may indicate the company is not using its current assets efficiently, securing financing well, or properly managing its working capital. You may also want to look at these ratios in conjunction with previous periods as well as companies in similar industries. Number 3, dividends are greater than earnings. My favorite metric for dividend investing is the payout ratio. This helps me with understanding sustainability of that company's dividend. The formula for payout ratio is annual dividend payout rate divided by earnings. There needs to be context around this ratio. In general, good is 0 to 35%, healthy is 35 to 55%, high is 55 to 75%, very high is 75%, and unsustainable is 95% or greater. From this list, the healthy range is the most favorable to see. Number 4, fundamental business concerns. Now this could be a very timely assessment, but here are a few things to look at. Stock price movement, cash flow statement, declining earnings, and slowing earnings growth. Checking the stock's price performance over the last couple years is wise. Think back to the dividend yield formula earlier in the video. Stock price was the denominator. If the high dividend yield is due to a rapid drop in the stock's price, you should understand the why behind this. Further, earnings can be deceiving due to things like one-time accounting items. As a CPA that used to audit hundreds of companies, I fully understand how the accounting can sometimes be misleading. This is why it's important to compare it to the cash flow statement. The cash flow statement tells you the real story. It can oftentimes be more useful than evaluating the earnings presented on the income statement. Additionally, it would be wise to assess if there has been a decline in earnings or even a slowing earnings growth. You will be able to find all of this information using the financial statements of the balance sheet, the income statement, and the cash flow statement within the 10K or the 10Q. You can gather this for all public companies one of two ways. Number one, Company Investor Relations website, or number two, sec.gov, which is what I use. Okay, now that we have gone through what's important, let's talk about the math behind a $100,000 dividend portfolio. Let's use my favorite fund for the example, my Vanguard Total US Stock Market Fund, VTSAX. At just a 1.29% dividend yield when filming this, it would require someone to have $7.751 million in this fund to pay out $100,000 in dividends. But remember, dividends are not the only way to use that money. You can make a simple withdrawal of 4% of a total balance at just $2.5 million to yield $100,000 also. Let's use a high dividend yield ETF like Charles Schwab's SCHD. It has a yield of 2.89%. Therefore, to yield $100,000, one would need a little less than half of VTSAX, or $3.5 million. You still may be thinking, that's a lot of money. Now let's use a very high dividend yield individual stock like MO at 6.93%. One would only need $1.4 million to yield $100,000 in dividend income. And that, my friends, is where people go wrong. They stare at these yields and instantly jump to MO of these three examples. They lose sight of the investment itself and they throw their entire portfolio into one stock, or they do something crazy because they do quick math. They skip the 4 key bullet points that we discussed above. Dividends are great, but capital appreciation is key as well. This is why I care for dividends, but I do not solely base my decision on an investment to earn them. Sure, they may provide stability during economic challenging times, but there is more than one way to skin the cat. Understanding the type of investor that you are is essential. Once you find your jam, make sure you master your craft. If you're a dividend investor or looking to begin dividend hunting, I hope this helps you. Closure, I do receive dividends via my index funds, but I'm not a dividend investor per se. And as a reminder, if you enjoyed this video, make sure to click the subscribe button below. And lastly, I would love to hear your thoughts in the comments below, and I will see you in the next video.